Oh, Richard and panel, thank you very much for that extremely interesting discussion about our big issue in our industry. We're now moving on. Something a bit different. I mean, like I said earlier on, Marine Money and Standard Chartered did a survey just before Christmas. And one of the questions we asked the ship owners on the survey was, what's your preferred type of finance at this moment in time? And the vast majority put bank finance, conventional bank finance. This is probably a bit different from a few years ago where, for large deals at least, I mean, the preference was to go to Asia, especially to China. But now it seems to be solidly back in the hands of the conventional banks. So what we have now is a session which is called the $1 Billion Club. We have two shipping companies on the stage who have raised debt of $1 billion during the past 12 or so months. We have Hugh Baker, Managing Director of Scorpio USA, Achilleas Tasioulas, Chief Financial Officer of GasLog Limited and GasLog Partners, and as moderator, we have Gaurav Moolwaney, who's Managing Director of Transportation Finance at Standard Chartered. Gaurav, please.
Thank you, Kevin. Good afternoon. I appreciate we are just before lunch and we are keeping you from your meal, but bear with us. I'm sure it's going to be a good discussion. So let's talk about the ship finance market. We know that it is estimated to be about $300 billion. We hear estimates of about something like $30 to $50 billion getting financed or refinanced every year. These are not insignificant numbers. But what we also know, for all of us who've been doing this so long, is there are three characteristics, right? We see a lot of small bilateral club deals. We see a lot of deals which are generally private, not so much in the public domain. And the small ticket sizes, we see $30, $50 million, we see a couple of $100 million. What is uncommon is seeing billion-dollar deals. But I think last year was different. Last year in the market, we saw some good large transactions come through. And I'm very happy here that I have Hugh on my left from Scorpio with a $1 billion financing closed in the summer, and Achilleas from GasLog, who orchestrated a $2.8 billion facility. So, and I'm also very pleased that actually we were part of those landmark transactions. But enough with me, so I'm going to get into questions. And perhaps since you're on my left first, Hugh, I will start with you. Let's talk about the beginning. How did this deal come about? Why a big deal versus a series of bilateral clubs?
Thanks, Gaurav. It really started out as a small deal. I think that what we did as a company was really look at and analyze what we wanted and what we needed. And we set certain red lines in terms of the terms and conditions that we would accept. And we really sort of then began discussions with our lenders and really found out what their appetite would be for those kind of terms and conditions. And, as that process evolved, the numbers kept getting bigger. We became more comfortable that more banks would join. We became comfortable about what the bank's red lines were and what conditions we could effectively push on and what conditions we would have to accept. And we really started out with a $250 million transaction, and then it became we talked to them about a $250 to $400 million transaction, and then after a lot of feedback, we started talking about a $600 to $750 million transaction, and eventually we had to sort of basically just say we're going to cap it at $1 billion. But that was really because throughout the process, we were getting feedback from the banks that they could meet our essential needs. And going on to what our needs were, we wanted a competitively priced deal. We wanted the flexibility of a revolving credit, and we wanted really not to have to make any kind of real concessions to what we were comfortable with.
Thank you. And Achilleas, similar approach, or where did this all start?
Yeah, can you hear me? Yes. In a similar manner, this deal really started years ago. The GasLog group has been transforming the last years. We did a series of transactions, the take private at the parent, we unwound the MLP, we reconsolidated the business, we simplified our corporate structure. We took advantage of the opportunities in the market, in the LNG market, to de-risk our exposure on all the tonnage. So I would say that having also the experience from the capital markets, you basically need to read the market, and the market was there for the business and for the group. You need to build your relationships with the bankers and understand the system. And basically, if there is a message that, from my experience in the private markets or the public markets, is that you basically take the money when they are available and not when you need them. So and it was the right moment. So overall, the transaction didn't really, it wasn't different from the way that you execute a transaction either in public markets or in the capital markets. You need a good story, you need the window to be open, and you need to act fast. And this is how it goes.
I like the statement about not taking money when you need it. I think banks also work in a similar way, but I'll refrain from commenting on that. So, I mean, $2.8 billion was a large number. Did you feel, as you were sort of going through the process, that it was going to be easy to achieve? And I guess one from just the liquidity in the market, but obviously you need to optimize your economics and your terms. Did it feel along the way that it was an easy task, or?
It's never easy, but proper planning, proper selection of your leads, and the very strong relationships that you need to build with the banking sector, and it's a continuous effort. It's not a transactional effort. And basically, proper structuring and realistic expectations. So it requires a lot of good planning and a robust process.
And Hugh, you sort of spoke about sort of building up, right? And I guess you were following the feedback from the banks as you sort of increased the ticket size. But now that at the end of it all, as you look back, was this how you would have choose to do it again if you had to do it all over, or would you go back and think about, let's do 20 bilaterals, 3 ships, 2 ships?
I think certainly if we did it again, we'd try and do it cheaper. But no, I don't think we have any regrets. And I think that, what we were looking to do was to create maximum flexibility. And in the very specific case of our transaction, we wanted to put a revolver in place. And I think that as a public company and as a client to many of the banks, they don't want us to have multiple revolvers that may be drawn in different ways. So if you're going to do a big facility, having it as a revolver is clearly a good idea, because you really only want, you might have numerous term loans, but you only want 1 or 2 revolvers in your financial structure. So for us, it was very much, let's build a big revolver. And we structured the facility as a 50% term loan and 50% revolver, really because we thought that the term loan would make it easier for us to sell the revolving component. I think that's true. If we were to do it again, we might have been more aggressive and tried to get 100% revolver, but that would have affected pricing. So to answer your question, we're pretty happy with what we did, and I don't think we would do it too much different.
And so sticking with the revolver element a little bit, and so we typically see the good old-fashioned amortizing term loans. But both facilities, and Achilleas, you also choose to have a revolver in your structure. And again, what was the thought process behind that? Was that similar to what Hugh said? And why did you put that element in?
I mean, having the revolver was extremely important. It was part of the strategy and the deal structuring from the beginning. It is a very good tool that if you use it wisely, it will help you significantly. It is indeed part of the core of the transaction. Sorry. We combined 23 vessels in this facility, so there is a lot of security that it could afford a revolver feature, and it was a key part of the strategy. We actually gives us a lot of flexibility to take actions in our capital structure. We have already used part of it to buy back some prefs, and actually, if you use it wisely, it can provide incremental benefits, and it has a multiplier effect. So it's a great tool.
I think what Achilleas said was absolutely correct, and I think that you have to look at the fact that both GasLog and Scorpio are really big companies, and there's no point in being a big company unless you can get some of the advantages of that. And one of the advantages is that you can go out and have arrange very flexible financing. And so, you know, particularly, and in our case, we have a very, very volatile income stream. We're predominantly a spot market player in the product tanker market. And with that volatility of income, the revolving credit facility is very, very helpful because, you know, we are effectively managing our cash and we have a lot of cash coming in right now, and it's extremely helpful.
Thank you. And we've all celebrated the successes of the deal, but let's look back. What would you think was the hardest part of doing a transaction this size and with the large syndicate of banks? I know there were lots of challenges. It can't be easy, but if you had to try and narrow it down, what would you think was the most difficult aspect?
Well, to our surprise, the challenges were less than expected, I have to admit. We are talking about a transaction that it wasn't a public deal. Basically, it was done with 14 relationship banks. It took us from launching to signing 3 months, which is really impressive. And it just shows that the window was open for GasLog, for the LNG, the liquidity in the banks was there, and the relationship was strong. Nevertheless, it is a big transaction. We had the benefit of being private, not being too worried about the public markets, so we could really pull the plug anytime we wanted. So this is a significant benefit. Of course, everything worked well. And as always, it's the things that you cannot control. So the geopolitical volatility is quite high. A new war was starting in Middle East. You didn't know how it will develop. But eventually, there was no disruption in the market that it could stop the transaction. The key here is to act fast.
I think we took a very non-confrontational attitude to our lenders, and we really work hard and to be as transparent as we can as a company, and we really work our bank relationships very hard. And I think a lot of our bankers probably see far too much of us, and I can't apologize for that. So we didn't really see any big issues with the facility. It simply evolved into what it did, and that was because the banks really wanted to support us and wanted to support the loan, and it was a pretty satisfactory experience. And you know, banks such as Standard Chartered effectively got comfortable with it and supported the transaction.
Thank you. I'm quite pleased to hear that all banks are fantastic. And also that you didn't mention anything about documentation or KYC with a large syndicate like that.
Well,
But
actually, the new structure is different because it is a holding company type of lending secured by assets. It's not, the borrower is not the vessel owning entity in our case, which makes the transaction much more smooth. Logistically, it's easier, KYC is easier, management of the logistical part of the execution, it's easier. So I have to admit that it is transformational, and it is how transactions should be actually. It's very helpful.
yeah, now that you mention it, I think similar with the Scorpio transaction as well. So I think, yes, it was fewer hurdles to cross. Moving on, I think some of you in the room are aware that my risk head is also somewhere here in the audience, so I'm going to ask a risk question. Let's talk about refinancing risk, right? So a large deal like this obviously means a large refinancing in, say, 2028, as opposed to doing a series of deals with staggered maturities that will give you more flexibility. So how are you thinking about that? Is that 2028, so be a big year to put together some liquidity, and again, also at the right terms and at the right price at that point in time? Hugh, with you first, maybe.
It's certainly something we'll think about, but the key thing to realize, and we had this discussion with our own board about this, is that, you know, amortization, you know, de-risks the company. We're not talking about refinancing $1 billion in 5 years' time. We're talking about refinancing a loan that would have amortized to slightly below $500 million. So you're really looking at a much smaller risk, and the risk goes down over the period. So if it wasn't amortizing, I think we would and should be concerned, but because it's amortizing, we're really less concerned. And the other part of that is that, you know, we know, and I can tell all the banks in the audience that, you know, we're expecting that facility to be rolled over in 27 or 28, and so we're not really that concerned about the maturity risk.
I would agree, yes. And just to add that, you know, these are amortizing facilities secured by assets. We live in an inflationary environment. I'm really struggling to see market values going, you know, collapsing. So we feel confident. And again, as I said before, there is a revolving element, wise use of it to build the capital structure that it will support the business. It's key, and this is the plan. So I think it is a risk that it is mitigated.
And just leading from on that question, obviously you are speaking to a large set of banks, and we have our views, but obviously you see a large pool. How are you seeing the financing market evolving in the coming years? I mean, in your conversations with lenders, do you see that banks and mainstream banks will continue to play a big role? Do you see that changing in 3 to 5 years from now? And also, you know, changing expectations around ESG and all the regulatory guidelines that are coming in. What is your read across from your discussions with banks?
Well, I don't expect drastic changes in terms of the existing setup. I'm expecting banks to remain there. For us, relationships are extremely important, so we pay a lot of attention on that. Leasing, for example, it will be there, it will continue maturing. I think that also the companies need to mature. So if you look back at GasLog's experience, depending on the strategy and the cycle that the company was following in terms of growth or maturity or whatever, we took advantage of every opportunity that it was out there. We have been in the capital markets, we had an MLP, we unwound that, we took it private, we had private debt, we have public debt. I mean, diversification is important, depending on your strategy and the cycle that you are. So I think that more or less this will continue. and I expect the banks to be there to support the business, and especially the good business.
Hugh, from you?
I agree with Achilleas. I think the abundance of capital out there is absolute. I think we're seeing a situation where the mainstream commercial shipping banks are all really focused on the top tier of customers, and if you're one of those top tier customers, I think that there is an abundance of capital available. I think there's also enormous amounts of capital available in the ship leasing sector, and also the alternative credit sector. I mean, all of those sides of the business are really trying to lend money at the moment. And then, as a larger company listed on the New York Stock Exchange, we have access to the public equity markets, the public debt markets, the Norwegian bond market, the Japanese operating lease market. You can literally go down the list of different sources of capital available to us. But I think the core source of capital is the mainstream ship finance bank market. Now, we are getting very mixed messages from the banks. I think that they are, some of them are very concerned with ESG and the trajectory of the Poseidon Principles and some of those issues. And others are very concerned about Basel IV, and equally others are concerned about return on capital and velocity of capital and issues like that. And I don't think there's a real consensus. So there are a lot of clouds on the horizon, but because there is so much capital available from all of the main sources, and all of the main sources of capital are doing rather well. I mean, the banks are lending to us because they're very profitable at the moment. They've got very good experience in their shipping books. And the one thing all the bankers are telling me is that they're not, they don't have any losses on their books. They don't, they don't have provisions. They haven't had any big credit issues coming up. And so we have a very healthy bank market, but all the other markets are pretty healthy too. So I think there's a lot of money out there.
Since you mentioned sustainability, there is a sustainability feature in our facility. This is something that we wanted. I have to admit that I didn't get the feeling that it was a deal breaker if we didn't have it. So, which goes back to the liquidity and the availability of the banks to execute transactions. So, sustainability or ESG targets or whatever you want to call it, it will probably play a much more important role in the future. We are getting there, but today, there is more work to be done. We elected to have it in the structure, thinking also the refinancing of the balloon. It is something that you want to have and to tick this box down the road, rather than it was a must today.
No, and you're right. I think from our perspective as well, we've seen, and we've discussed it at previous Marine Moneys as well, how we're seeing the discussion around sustainability shift from a good to have to a must have, and I think we are on that sliding scale in the right direction. We have 5 minutes. I will switch gears very quickly from financing, and I do want to touch upon the markets. I mean, we're looking at GasLog and Scorpio, your size and scale, your bellwethers for your respective segments. So I'm very keen to also get your view on the market. Maybe we start with the LNG side. Maybe not struggling so much with the propulsion of the future question, but there is a very large order book. 50% is large. And we can say that the new builds are contracted, but where do you see the outlook? 3 to 5 years, or maybe even sort of the 5 to 10 year horizon? How are you seeing the industry?
Indeed, the order book is large. The market has been very strong until today, more than what we expected. All this volatility and the geopolitical uncertainty, it has worked in our favor in terms of the LNG, the order book is a concern. The market is doing well. It remains to be seen how 2025 and 2026 will be when all these vessels will hit the water. Nevertheless, it is supported by increased supply. So the LNG fundamentals seems to be strong. Of course, we have seen in the past, and probably it will happen in the future many times, that projects deliver on time, projects don't. Vessels deliver on time, projects don't. So this may create an imbalance in the market. But overall, in the longer term, post this peak of the new building deliveries in 25 and 26, I believe that the LNG fundamentals and the LNG macro will remain very strong. So we are quite optimistic. So the question is, as a shipping company and as a ship owner, what exactly are you doing to deal with that? And we have a clear strategy. We have been absent from aggressive ordering, and we have been managing our balance sheet, refinancing our facilities in advance when the money are there, and not when you need them. I mean, it's so simple.
And Hugh, from your side, on the product tanker side, I mean, as you said earlier as well, the markets are doing so well. Two specific questions. One is obviously around the order book, and the crude order book is sort of very low at the 4% mark, chemicals at 8%, product tankers closer to the 12%, I understand. So how do you see that? And also, I want to hear your thoughts around the propulsion question for the product tanker segment.
I think I'll deal with the propulsion first. We don't have any ships on order, and one of the reasons for that is that we are, I think, still not certain as to which path to follow in terms of propulsion systems. I think we're very happy to wait. We're very happy for other people to move ahead of us and order ships. We have a very young fleet, average age of 8 years, and so we're not really that concerned about the propulsion systems, and that decision will be made by other people in the market, and we look forward to following those people in due time. But right now, we're not going to tell you that there's what the right thing to do is, because we don't really know. Product tanker market's in a great place. Even the order book, you talk about a product tanker order book of 12%, but every LR2 every Aframax tanker that is ordered is actually an LR2, and it's not clear that so when you're looking at the LR2 order book, you're really looking at the Aframax and LR2 order book as well. So, we don't see the order book as being particularly threatening, and I think we do see the supply-demand situation being generally positive for the next few years. And even without the sort of geopolitical events that have really propelled the product tanker market, we think we're in pretty good shape.
Good, excellent. I think we are out of time, Kevin. I don't know if you want to open for questions or we let everybody go for lunch. Well, thank you, everyone. Thank you, gentlemen.
Thank you.
And enjoy your meal. Thank you.
Thank you, Gaurav, Hugh, and Achilleas, very much. Okay, now it's lunchtime. Like I said earlier on, lunch is there's a seated area through in the room here, and there is a kind of standing buffet on the balcony at the back. We'll try to get back on schedule, so we'll meet again here in 1 hour, please, in an hour. Thank you.